Good morning, my name is Christopher Charlton and I'm here to present to you the weekly review of the currency markets from Centre Asset Management. Firstly, I want to apologise for the lighting in this video. The clouds and the sun screwing up all my webcams, so please bear with me on that. Thank you. Let's go. 3 years ago, a shooting at the Virginia State University claimed 33 lives. It was the deadliest mass shooting in the history of the US. This week, the Virginian General Assembly approved a bill that allows people to carry concealed weapons into bars and restaurants that permit the sale of alcohol. At the same time, it repealed a 17-month law preventing people from buying more than one handgun per month. Since the days of Davy Crockett and buffalo hunting in Manhattan are long gone, I thought the rationale behind the US gun laws was primarily about self-defense. How many handguns do you need to defend yourself, especially after a few vodka Red Bulls? It was finally confirmed that Goldman Sachs did indeed receive $14 billion of taxpayers' money from insurance against dodgy assets that they sold to AIG in the first place. Agora Financial put it quite well. It's like selling homemade napalm to a teenager and then buying fire insurance on his dad's house. President Obama tried valiantly this week to acquire the help of the Republicans in the passing of his healthcare bill. Failed completely. They couldn't even agree on the amount of time each speaker had to speak at the meeting. Now the Democrats will have to try to force the bill through by themselves. Obama has staked his reputation on this and that of his administration, so it should be important to see how that develops. Meanwhile, in Europe, the Greek tragedy continues with a senior politician, Theodore Pangalos, resurrecting the memories of the Nazi invasion of Greece in the Second World War and the theft of the Greek gold reserves. Interestingly, the Germans did not rise to the bait, and even the Bild-Zeitung, the German equivalent of The Sun in the UK, was relatively subdued. That said, the German magazine Focus, in its latest issue this weekend, shows the Venus de Milo now raising her middle finger under the headline "Cheats in the Euro Family." The consumer rights group in Greece has already called for a complete boycott of German products and stores. The fun continues. A good example of the difference between Germany and Greece was this week at Volkswagen, where the German IG Metall, the largest union, agreed to extend their collective bargaining agreement for another 5 years. This basically means that they link their wage increases to the productivity of the company and in return receive more job security. Also, the Lufthansa pilot strike was called off this week. In Greece, 1 in 3 workers are employed by the public sector, which means that any strike basically shuts down the country. Greece's shadow economy accounts for over 25% of GDP. Tax evasion costs the government over 15 billion euros a year. One asks oneself, why is there such a lot of tax evasion in Greece? One of the reasons is that countries like Greece, Portugal and Spain are basically only recent democracies. Before that, they were dictatorships. The older generations are not accustomed to have governments that actually have their interests at heart. Therefore, the family came first and the state second. Evading taxes is regarded more as a sport rather than a crime. This must change, but as I said last week, this is a generational issue. In the meantime, the immediate problems have to be solved, and this seems to be progressing. On Friday, the German state-owned KfW Bank reported that it would be part of a joint scheme to grant up to 25 billion euros in loans. The spread of the 10-year yields of Greece over Germany narrowed to 335 basis points, and the euro rallied. Greece also replaced its debt management chief with a former Goldman Sachs banker. As the Goldman alumni already run the US government and the Bank of Italy, I suppose the ECB will be the next step. As I've said previously, the Greek problem is a question of confidence, not so much the debt itself. The Prime Minister of Hungary put it well: confidence or trust in the financial markets is like the air that you breathe. You don't realize the importance of it until you begin to choke. Greece will become the first sovereign state that is too big to fail. others will follow. On that issue, the Bank of England's Mervyn King warned that failure to act now on reform will in time lead to another big financial crisis, and thinks the implicit subsidy of too big to fail should be removed. As well in the UK, various calls for spending cuts were rebutted by Alistair Darling, who said that whilst private sector investment remains weak, cuts could derail the recovery and push the economy back into recession. What recovery, I ask? It seems that the economy grew at a revised 0.3% last quarter, so therefore we're out of a recession. Why does it need 2 quarters of negative growth to go into a recession and only 1 quarter of positive growth to come out of a recession? Despite the slight improvement in the GDP figures, the market reacted negatively, as it was suggested that most of the improvement was due to government spending and not private demand. The Bank of England also reported that net lending to UK businesses was weak in December and will probably be weak in January as well. This is the problem. In the US, bank lending has fallen at the fastest rate in history. As long as lending contracts and becomes more restrictive and expensive, companies will be forced to reduce their costs of financing by either raising prices or laying off staff. There will be no recovery until the banks resume normal lending practices. In the meantime, the doomsday soothsayers are out in force again. Jim Rogers, famous for his Soros days, warns of a collapse of the pound within weeks. While his last forecast was not too good, on the 21st of January 2009, when the pound was at 138 to the dollar, he forecast a meltdown towards parity. It actually bottomed out 2 days later and rose as high as 170. Maybe he will have more luck this time. Also, the Wall Street Journal reported that a group of all-star hedge funds had met for an exclusive dinner and had decided that the euro could also fall to parity against the dollar. It would be a career trade. That sounds to me like we're pretty close to the bottom in the euro. Whatever. We maintain our medium-term targets for the euro-dollar around the mid-120s and for the pound against the dollar in the mid-140s. For anyone who wishes to check back on our forecasts, you can find them on our website, www.centre-am.com, under monthly reports. So how did the week look? Well, the major moves were a continuing fall in the pound and the yen regaining its losses of the previous week. The yen gains against the commodity currencies were due to the fall back in commodity prices. Copper fell 2.5% after gaining nearly 8% in the previous week, and oil was down as well. If you put the two together, it gives you a better idea. I use the mouse here. You can see that the pound has been falling the previous week and last week. The yen, though, fell drastically in the week of February the 15th and regained all its losses last week. Commodity prices gained here, lost here. The dollar itself actually didn't do very much in both weeks, so there's not too much to speak about there. This week I'd like to talk about the euro sterling. We've seen through the month of February a 4% rise in the euro against the pound, and this looks likely to continue. I think this chart sums it up quite nicely. I don't want to talk about the fiscal problems of the UK or the elections due, just about the trade imbalances within Europe. Germany had a trade surplus of $185 billion last year, and Britain had a trade deficit of about $126 billion. From a purely currency viewpoint, that would argue that the pound is probably still 10 to 15% overvalued against the European currencies. Over 60% of all trade, UK trade, is done with Europe, far more than is done with America. So from this rationale, one would argue that the euro sterling should move up towards probably parity. Our medium-term target initially this year was at 91, well, we're moving up towards that. If and when we get there, we'll review the situation then. Thanks for watching. Have a good week.